สวัสดีครับยินดีต้อนรับนักลงทุนทุกท่านเข้าสู่รายการพิเศษ FINNOMENA X Franklin Templeton การจับมือครั้งสำคัญระหว่าง FINNOMENA และ Franklin Templeton ที่จะมาช่วยมอบความรู้การลงทุนระดับโลกให้กับนักลงทุนชาวไทยทุกท่านเลยครับวันนี้ผมสฤษฎกิจสิริสมภพจะมาเป็นผู้ดำเนินรายการในวันนี้ครับตลาดเอเชียเนี่ยในช่วงที่ผ่านมาเนี่ยถือได้ว่ามีความน่าสนใจเป็นอย่างมากเลยนะครับทั้งในแง่ของมูลค่าการเติบโตรวมถึงปัจจัยพื้นฐานที่ขับเคลื่อนในวันนี้ผมได้คุณ Alistair Macdonald ผู้จัดการพอร์ตการลงทุนสำหรับนักลงทุนสถาบันจาก Franklin Templeton เข้ามาช่วยให้ความรู้เชิงลึกรวมถึงมุมมองการลงทุนที่ว่าในอนาคตเนี่ยตลาดเอเชียจะสามารถเติบโตแซงหน้าตลาดสหรัฐได้หรือเปล่าครับถ้าพร้อมแล้วก็ติดตามรับฟังไปพร้อมๆกันได้เลยครับ
Hello, Mr. Alistair. Thank you for joining us, for sharing the opportunity in Asian equity markets driven by innovations. But before we are going to the topics, could you please introduce yourself?
I'd be delighted to. Thank you very much, Kunal. My name is Alistair Macdonald. I'm based here in Singapore. I'm an institutional portfolio manager with the Franklin Templeton Emerging Markets Equity Team, and I've been doing this role for about 8 years now. Prior to that, I worked at Man Investments and Goldman Sachs in the Cayman Islands and London. And I should also say, before we jump into the presentation, I used to have the great pleasure of traveling to Thailand very frequently, both for work and for holiday. And all I can say is I dearly miss meeting our clients and enjoying the good food and the good hospitality in Thailand. Certainly hoping we can all start traveling again soon.
Yes, that seems to be nice. So when I think we should start the sessions, okay? So when we talk about the emerging markets, resilience and flexibility are key advantages that we should not overlook. Could you elaborate more about this?
Absolutely. So we think emerging markets is very often a misunderstood asset class. And so we're delighted again to have the opportunity to speak to you and your clients about some of these misperceptions. And hopefully we can impart some information that helps to challenge these concerns that many clients and investors have. People think of emerging markets and they think of risks, they think of state-owned enterprises, they think of currency fluctuations, when really the story of EM has changed substantially over the last decade. So I'll be happy to outline a few of those changes as we go through. And so starting off, we want to emphasize and really speak about the resilience of emerging markets. Over the last year, we've really seen this evidenced very, very clearly by the exceptional degree of outperformance with regards to health outcomes, economic growth, and indeed market outcomes across many of the leading Asian economies in emerging markets. Truly, when the world really needed a safe haven, many investors were actually surprised to find it, both literally and figuratively, here in Asia. The concept of emerging markets of being a high beta, higher risk play during volatile time periods was clearly not the case last year, taken in aggregate, largely because of that outperformance that we've seen here in Asia. We believe this is largely underpinned by 3 new realities in emerging markets, which serve as an ideal preface before we go into more detail in this presentation. So running through these in turn, first of all, what we've seen from an institutional perspective is a substantial strengthening of institutions and also of policy making. We have far greater orthodox policy making seen in emerging markets in recent years and in particular last year. It wasn't in emerging markets where we have seen massive printing of money or massive unfunded fiscal stimulus. These experiments are taking place in developed markets. And largely those experiments are needed because developed markets in the US, my home, the UK, and across Europe, they need this stimulus because they've underperformed so substantially from a health perspective. The second key transformation that we've seen in emerging markets is the shift away from, broadly speaking, the old economy towards the new economy, which is to say that these economies are now underpinned more so by consumption, by technology, more sustainable drivers of earnings rather than what we've perhaps seen in the past, which has been a greater dependence on commodities, which tend to be a bit more cyclical, and other perhaps lower quality companies as well. A concurrent trend that we've seen alongside this is the improving ESG outcomes across emerging markets. We believe this is a key tailwind supporting re-rating of the asset class over the longer term. Of course, in terms of starting point, emerging markets are a little bit behind some of the developed markets, at least certain companies are, but that just implies that there's more room for improvement. It's also worth highlighting the extent to which many emerging market companies are the key drivers or the key providers of the technologies that are going to be absolutely essential for a greener future across the globe. This ties into the third new reality that we see, and it's absolutely critical, and it's the most important thing that we want to speak about today, and that is the extent to which innovation is now powering emerging markets. It used to be the case that EM was seen as a low-cost manufacturing hub. Maybe there were misperceptions of intellectual property theft. For example, a lack of truly innovative, high-quality companies, and this is something that has completely changed over the last decade and is evidenced as well in that transformation in terms of the economic weightages between the old economy and the new economy. So running through these points in a little bit more detail then, starting with that broader resilience and the institutional policymaking. This has helped to ensure that emerging markets have really driven global growth over the last 5 years. And so what we're showing on this slide is global GDP growth split between emerging markets, the blue bar, and then the rest of the world, the green segment of the bar. Now, critically, this includes 2020. And in 2020, emerging markets essentially accounted for overwhelmingly the vast majority of growth, because there were only a handful of economies that actually did grow during 2020, most notably the likes of China and Taiwan. Now, what we see, however, is a complete disconnect between the drivers of global growth and what is driving equity markets. Emerging markets are heavily underrepresented in the MSCI world. Accordingly, even an index following investor tends to be, is implicitly structurally underweight in emerging markets. And then many investors in turn, perhaps less so in Asia, but many investors in the developed world have underweights even in the context of the MSCI World Index. We think this is completely unjustified given what we've seen over the last year and what we expect to see continuing over the future. If we just look at one country, the most important emerging market, China, this helps to illustrate the disconnect that we see. As a result of COVID, the date by which China is going to overtake the United States as the world's largest economy has been shifted forward to 2028. China was previously expected to overtake the United States in 2033. Now, if we look at China's weight in the MSCI world, it is a mere 5%. Versus the United States at 57%. And so a very easy question for your audience is, which of those weightings do you think is most likely to grow over the next years, over the next decade? Is the US likely to become 60%, 65%, or are we more likely to see China's weighting within the index grow? Of course, we think the latter is more likely, and that the opportunities in China are being heavily overlooked by most international investors. Fortunately, being based here in Asia, I think we're preaching to the converted already. I think everyone here in the region recognizes not just the importance of China, but also the development taking place and the manufacturing taking place in the likes of Thailand, and the innovation taking place in Taiwan, Korea, and elsewhere. And so this is less of a news story for many of the people, I'm sure, that will be listening to this. But nonetheless, it's important to reiterate this point. We spoke already about the change of emerging markets away from the old economy towards the new economy. And so here we're just illustrating that very, very clearly, visually. We can see about a decade ago, it was the first time you saw the new economy become larger than the old economy across emerging markets. Another question perhaps you're asking is, what do we mean by the new economy? So here on the right-hand side of the slide, we're just illustrating the sectors that we would classify within the new economy. So you can see the consumer sectors, IT is another key sector, communication services, another sector, and healthcare is a smaller one. What do we mean by the old economy? Well, as mentioned earlier, these are first and foremost the cyclical commodity orientated sectors, so materials and energy, and also industrials, largely speaking, would come under that same category. Now, what we can see here in this chart is I think two key takeaways that we would like to emphasize. The first is this gradual increase in the weighting of the new economy at the expense of the old over the last decade. But equally importantly has been the acceleration of that change over the last year in particular, driven by COVID. And so there are a couple of takeaway points here. One is the fact that entering the crisis, entering COVID-19, emerging markets, and of course, again, primarily led by Asia, these economies had a greater level of digitalization across their economies, a greater orientation towards technology in the new economy. And this placed them in a better position to be able to respond to this crisis. We saw that, of course, in China. We've seen that here in Singapore with lockdowns and track and trace technology. We've also seen it in the way companies and businesses have shifted online very, very rapidly across Asian economies in particular, but also seen elsewhere in emerging markets. In addition to this supporting these economies going into the crisis, it also enables these economies to emerge more rapidly and to have performed better during the crisis. We all know the big tech names and broadly speaking, new economy names have done much better during this crisis because you've seen better earnings visibility and you've seen a greater an acceleration really of these structural underlying trends that supported many of these businesses in the first place. So it's both better prepared these emerging markets entering the crisis and positions them better to recover after the crisis as well. Now, moving on to talk a little bit more in detail about innovation, which will be the focus of this presentation. Here we're outlining a couple of key stats we want to outline that help to counter the misperception still held by many investors that emerging markets is really just still a low-cost producer, and maybe there's certain economies that engage in intellectual property theft and so on. By contrast, actually, what we see here in terms of the evidence is that emerging markets are investing ever more heavily in their own intellectual property. This chart is illustrating that EM now substantially outweigh the United States and Japan in terms of overall number of patents granted. This is dominated by economies such as China in particular, but also Korea, Taiwan, India, and a host of other economies as well. So you're seeing a broad-based improvement in the intellectual property and the intellectual capital across emerging markets. Of course, China is by far and away the leader in EM with regards to this. And in fact, in 2020, it was the first year when China actually overtook the United States to become the world's leader in terms of research and development spending. And so that is approximately $600 billion in spending. And so this has been a gradual improvement over several years. This isn't an anomaly just because of COVID. This has been building up, and 2020 just happened to be the year when China overtook the US. This, of course, has very long-term importance with regards to future business opportunities, future competitive advantages of the companies in which we invest. We think these sort of changes are being underappreciated by many investors. And so when we think about innovation more broadly, we've tried to break this down into sub-themes that help us, admittedly somewhat arbitrarily, but also provide a framework by which we can think about the types of companies that operate in emerging markets and stand to gain from trends in innovation. So these are outlined on this slide. So starting with disruption, really this is focused on new technology, creating new business models. There are some very obvious examples ranging from e-payments through to e-commerce. Then we can think about transformation. Now, what do we mean by this? These are those companies that are agile enough to adapt to the new technology, to adapt to competitors disrupting them, and hence to take control of their future. And some examples here are often companies that maybe are a little bit less exciting, or at least would have been previously considered less exciting. Financials is one of the obvious spaces where you're seeing a lot of disruption led by fintech, but where you're also seeing banks invest heavily in their own e-platforms, whether it's payments, whether it's banking online. So a response to disruption. We also see it in the case of, for example, the electric vehicle supply chain. If we look at battery manufacturers, electric vehicle battery manufacturers, these are typically what used to be very unsexy chemicals or materials businesses, which traded at very low valuations. But some of these companies have been able to pivot towards new energy, pivot to becoming market leaders in electric vehicle batteries. And with this, not only are they taking advantage of a very nascent trend that is at the very early stages of growth, but they also benefit from a broader re-rating that is associated with being linked to new technologies, linked towards more ESG-friendly outcomes. If we think about this more broadly, if we think about auto manufacturers, if you look at Tesla as a great example of a disruptor, and you look at how Tesla is valued, it's an astonishing success story. But then when one looks at some of the electric vehicle battery manufacturers, they're often trading at valuations that are a fraction of the likes of Tesla, despite supplying the most important and most expensive component of a Tesla vehicle, which of course would be the battery, as is the case with other electric vehicles. The final element here to highlight is digitalization. Now, what do we mean by this? Here we're referring to essentially the enablers of a data-driven world. So the infrastructure behind everything that makes our modern world possible. So that ranges from hardware, so chip technology, semiconductors, but also through to software, the cloud companies that have enabled so many businesses to shift online, that enable us to be speaking over the internet in the way that we are right now. And so across all of these themes, there is crossover. It's somewhat of an arbitrary split between some of them, and certain companies, of course, span different sub-themes, but nonetheless, we find this a very helpful framework with which to assess the opportunities in this space. And so over the next few slides, I'll outline a few examples of the types of disruption and change that we're seeing. So starting here with new energy. Now, we think, and this is perhaps especially important for some of our US clients, but we also think it's critical for our clients here in Asia, but it's to highlight the global implications coming from a change in energy usage or energy supply. Now, if we look at what the world is currently powered by, of course, oil is still the most important energy generator. And here we have the United States as the leading producer of oil and its related products, with about 19% global market share. Of course, you have Saudi Arabia and Russia being other key large producers of oil. China is a relatively middling power when it comes to oil production, with about 5% of total market share. And in terms of oil imports, China would be by far and away the largest importer in the world. So from a geopolitical perspective, this is a real risk to the rulers of China. They don't like being dependent on having to import oil from unstable places or unreliable partners. And indeed, this has been a key foreign policy issue for the United States that we've seen in the past, which helps to explain some of the involvement in the Middle East over the course of many decades. Now, if we think about the energy of the future, it probably isn't going to be oil. What is more likely to be the energy of the future? Of course, there are new energy more generally is quite broad, but if we just look at one area, that would be solar. Now here, in terms of solar panel or solar module production, the US has a very, very meager 3% market share. Now, if we look at China, by contrast, it has 71% market share. And it doesn't just have this dominance in solar module production, it also has dominance in terms of the key components of these solar modules. So the entire supply chain is essentially largely China-based. So the solar glass that is manufactured and then used for these solar modules. And so in the context of future energy generation and future geopolitics, this is an incredibly powerful statement, and one that ought to cause some some concern in the US and also illustrates the opportunity in China. And the final point is just to emphasize that despite all the news that we hear about solar and the growth that we see in solar, this is still very much at a nascent stage of growth. It has grown by 10 times in the last 10 years, but remains only 1% of total power generation in global grids. So there's a huge runway for growth. And critically, China is building a monopoly in that space, and one investing in those companies has certainly done very well over the last year and beyond. So an area that we're very excited by. Another example that is a little bit less geopolitical and maybe a little bit more fun would be to talk about gaming and esports. Frankly, I'm not much of a gamer, or at least I haven't been since I retired my Super Nintendo and N64 quite a few years ago, so betraying my age. So I was quite amazed when we did some of the research and building this slide. But we were looking at as an ideal way to illustrate the power and the growth of e-sports would be to look at the prize money. And in 2019, Tiger Woods won the Masters, and he won a rather handsome $2.1 million. That's a pretty good winnings. In Wimbledon that year, Djokovic won just under $3 million. And to my amazement, when I saw the figures for esports, it's absolutely massive. So I think that the gentleman in 2019 who won the Fortnite World Championships was Kyle Giersdorf, if I'm remembering the name correctly. Not quite as famous as Tiger Woods, but he got paid a lot more. And in the case of Dota 2, I think it's Defense of the Ancients 2. Here, actually, that prize money is split over a team of 5. So each of the team members won $3.1 million. So incredible amounts of prize money. And this prize money is, of course, only affordable if the gaming industry is generating a huge amount of revenues and is seeing growth and so on. And so from a sporting perspective, however one defines sport, this is an incredible growth opportunity, and it's the type of audience critically that many traditional sports would absolutely die for. It's a young audience, it's a growing audience, it's diverse, split across the world. You know, I know quite a lot of my friends love to watch the Masters, and quite a lot of them look like me. They have gray hair. Whereas the people that are the future and are generating growth going forwards are maybe the guys watching the esports. And what we see here is $1.1 billion in revenues, very sharp year-on-year growth, a massive audience already, and it's very much an Asia-dominated audience. On top of that, this is also an area where there are ample business opportunities. If we look at the case of leading gaming companies in China, Tencent as a prime example, that's a company that has invested very, very heavily across a whole host of different subsidiaries and companies into which it's invested. So Fortnite, for example, I think that's Epic Games that is the producer of Fortnite, and China is Tencent has a big investment in that. Tencent holds as a fully owned subsidiary, I think it's Riot Games, which holds League of Legends, if I'm not getting all of my names mixed up. Dota 2 is actually a US company behind it, Valve. But I think one of the key messages here is it's a massively growing market. And again, this is being led increasingly by Asia and Asian companies and Asian consumers. Now, this is probably the most obvious disruption story we could have chosen. So say number 3 here, and that is e-commerce. Now, hopefully what is less obvious is the extent to which we're seeing rapid growth outside of Asia. And so over the last year, we saw, by US standards, incredible level of growth, 31% growth in terms of online sales transactions by value. But compare that with Russia, Mexico, and Brazil, and you see it's been an absolutely incredible growth figure. We look at a country like Brazil, which has obviously suffered quite heavily from the pandemic, and this has been an amazing opportunity for local homegrown businesses to thrive in terms of e-commerce. You see more of a hybrid business model there that leverages local stores for delivery and pickup and so on. So the logistics can differ a little bit from one country to another, but nonetheless, the overall story is very, very clear, and it's one of phenomenal growth, and many of these opportunities are overlooked. Of course, China remains the behemoth when it comes to e-commerce, by far and away the world leader. And by 2025, it's estimated that e-commerce in China will be over $1 trillion larger than that in the United States. So it will be roughly 3 times the size of the United States. So the size of the market is really quite incredible. Now, a key point as well to emphasize when speaking about e-commerce, when any of us order something, it turns up on our door, it seems very, very simple, but actually the underpinning the what you see really in terms of e-commerce is the tip of the iceberg. When you look at a company like Alibaba and Amazon, you see just the tip of the iceberg. Underpinning all of that is a massive level of different subsidiaries and companies and logistics and so on that make it all work effectively, ranging from payments through to compliance to tax to delivery and so on. So the complexity of these businesses is critical to recognize. And with that, there are both opportunities in the smaller capitalization space, companies that work with Alibaba or other competitors across emerging markets. And it also illustrates the sustainability of the earnings power of a company like Alibaba. This is requires the ability to manage an awful lot of things very, very effectively. Moving on to transformation as our second sub-theme. Now, what we're highlighting here is electric vehicle batteries. We've already spoke about this previously, and the importance that we think is often overlooked in the case of the supply chain for electric vehicles. Certainly when one looks at the valuations of leading auto manufacturers versus some of the component providers. What we're illustrating here is both that in the top bar chart, we're illustrating the extent to which, again, Asia dominates the supply chain. Korea is the number one. And again, this is a place where you've seen relatively unexciting chemicals companies such as LG shift away from that and pivoting towards new energy businesses, which have attracted a far greater degree of capital flows and with it a re-rating. But the story remains very much the same as solar. This is a very nascent story. It's only the beginning. You've seen, again, more than 10 times growth in sales in electric vehicles over the last decade. But the total vehicle stock of electric of EVs is roughly 7 to 8 million out of a total autos globally of about 1.4 billion. And so they are less than 1% of total the total stock, which just illustrates again how much further the story has to run. Now, in the course of highlighting some of these prior examples, it's important to emphasize that much of what occurs would be impossible without that hardware and software underpinning it. So the digitalization aspect, the infrastructure. So what we see is, first of all, a massive growth of computing power in pretty much everything. Our mobile phones, as we know, are an absolute wonder, and each iteration, each new iPhone or Samsung or even Huawei is enormously better than the last. But this is spread beyond your pure play electronics. You look at autos, you look at security systems in homes. Almost everything is moving towards being smart, being connected to the internet. We've just chosen one example here to illustrate this, and that is the value of electronic components in autos. This has ranged from or grown from essentially a rounding error back in 1970, 5% of the total value of a car. And now we're currently at around 40% of the value of a car, and that's expected to increase to about 50% by the end of this decade. And it's what's critical to recognize here is that this growth in computing power is increasingly dependent on a small number of very successful businesses. Asia, again, is leading in technology here. When it comes to semiconductors, these are what power the chips. These are what underpin the chips used in all of these modern day wonders that power the world. Asia leads in the manufacturing. Now, semiconductors, historically, you would see the design would be carried out by one company, and then the manufacturing would be carried out by another. Now, typically, the manufacturing was something, to generalize, that was outsourced to Asia, to more specialized providers. But much of the intellectual property and much of the value in production essentially lay in the design of those chips. Now, what we've seen over the last decade is increasingly the balance of importance or of intellectual property in that equation shift more so to the production side, given that the complexity of producing chips has grown exponentially greater as chips have become ever smaller and smaller and smaller. And so this has encouraged the leaders to become ever more ahead. Now, if we look at Taiwan's TSMC, this models itself as the foundry to the world. And so it is producing semiconductors for everybody, from Apple through to NVIDIA, through to everyone and anyone. They produce the chips. Now, with this has come scale, has come additional intellectual property edge, the ability to continually expand CapEx. Now, by contrast, if we look at Intel, this is one of the remaining businesses that both designs its chips and manufactures them, the leading US business in semiconductors. Now, TSMC, the call-out statement on the right, has produced over 1 billion 7-nanometer chips by mid-2020. By contrast, the equivalent model that Intel is releasing, they have yet to actually start mass production. So they're aiming for this year. And then in the future, what is likely to occur is that they are going to start outsourcing their production to TSMC. So we have a broader long-term structural trend, which is accelerating, which is an increased usage of computing power in everything that drives the modern world. And concurrently, we're seeing an increased concentration of production in ever few businesses, and they are predominantly based in Asia. So an ever greater portion of the value chain is being taken up. Illustrating this trend, some of you may have noticed that there were some news reports with regards to chip manufacturers, and specifically TSMC, providing a lack of supply to auto producers. And you saw auto manufacturing grind to a halt across many countries worldwide because they couldn't get their hands on enough chips. So that's an example of the importance of these semiconductor companies. We're just highlighting here more broadly some of the examples that we would talk about if we had a bit more time today. It's a very broad opportunity set. It's not just a story about China. It's not even just a story about Asia. There are a lot of opportunities beyond that. And we think many of these businesses are both misunderstood and overlooked by investors. There's been a much greater focus on the story in the United States with regards to innovation. And that is also reflected in the valuation of US equities. And so to conclude, we'd just like to highlight, draw this together and highlight that why this translates into an opportunity now. So we've spoken about the longer term structural drivers here and the transformation we're seeing in emerging markets. But why now? Well, essentially, the past does not look like the future. If we look at the past 10 years, US equities, of course, did very, very well. And there were a number of drivers behind that. They outperformed emerging markets considerably. And so if we run through the key drivers of emerging market underperformance over the last decade, we saw EM earnings growth and valuations and currencies decline relative to developed markets, relative to the United States. Do we think this is going to continue going forwards is the most important question. And so starting with earnings growth, if we look at the near term, emerging markets are expected to see a very, very sharp acceleration of earnings. Growth here expected to be by consensus of around 50% versus 41% in the United States. This is underpinned, of course, by that strength in economic growth. Another key factor that's worth highlighting is that a couple of the drivers behind strength in US earnings in the last decade have included share buybacks and corporate tax cuts. Now, with President Biden in power, it is very, very unlikely we're going to be seeing any tax cuts anytime soon. And it certainly looks like corporate tax cuts will be going up, and this will have a direct negative impact on corporate earnings in the United States when implemented. By contrast, emerging markets, as mentioned, simply haven't spent a vast amount on fiscal stimulus, nothing like the degree that you've seen in the US. So there's less of a need for those sort of corporate tax rises. So both the sustainable earnings power of these companies and sectors that we've spoken about, but also the broader macro drivers we think are supportive of earnings growth. The next factor we think is actually the most important, however, and that is valuation. Over the last decade, the number one reason why US equities have outperformed has been that they have re-rated. They have become more expensive compared to history. Now, the irony of this is that it is emerging markets that have transformed over the last decade. It is emerging markets that deserve a re-rating. As we've just highlighted throughout this presentation, you have a completely different asset class compared to the past, driven by the new economy, driven by increasing technological edge across a whole host of industries, and increasingly and importantly, improving ESG outcomes. And so we believe there is potential not only for US to see some derating, but also for emerging markets to re-rate. And so some of that gap to be narrowed, so very supportive of EM returns. Finally, in terms of currency, or rather not quite finally, but in terms of currency, here you've had, again, a very strong 10 years for the United States. We're not macro specialists. We're not going to try to give a high conviction view on where currencies are going to go. All we would say is we just highlight that the US has, and developed markets more broadly, have undertaken an absolutely enormous level of debt and are printing money on a scale never before seen in history. This has typically been associated with currency debasement in the past. Maybe that will occur in the future, but even if we don't see currency debasement, it's hard to believe we will see a continued long-term structural bull run in the US dollar versus emerging markets. So hopefully we can see some strength going on there. The final component is dividends. I don't think many people are investing in emerging market equities for the dividend component, but nonetheless, this is an area that has been positive over the last 10 years relative to the United States, and it's expected to be positive going forwards. And so with that, to conclude, hopefully we've been able to impart to the audience why we think they should be excited by emerging markets, why we think this is an asset class that has transformed and why it warrants more expensive valuations, a re-rating and increased investor retention. We're also seeing what appears to be investor recognition of that. You have seen a record-breaking length and size of inflows into emerging markets funds for now what is now 29 weeks and is totaling over $120 billion has flowed into emerging markets funds, of course, concentrated in Asia in particular. So investors do appear to be taking heed of this story, but nonetheless, globally, investors remain heavily underweight relative to where they were in the past and also relative to indices. So we think there's a very strong structural story that ties into a very strong why now for emerging markets. And with that, Kunal, thank you very much again for your time, and happy to move on to questions.
Okay, so got the questions. As we have seen, the emerging markets is shifting to the new economy more than the old economy that tend to be cyclical. My question is, would we say that the EM markets can be the next USA?
Great question. I think one can certainly make the statement that economically China appears very likely to be the next USA. I mean, it's forecast to overtake the United States by 2028, and it will do so at a per capita income that is much, much lower than the US. So the runway for economic growth is very substantial. Our view is that should, in time, will translate into equity market outperformance, not just growth, but critically the innovation that is underpinning it. And so you're absolutely right. We look at the last decade, the extent to which US equity market performance has been driven by really just a handful of big tech names. We do think that we're seeing a similar trend in emerging markets whereby big tech is driving returns. We expect that can broaden a lot more given the much greater diversity of opportunities across different emerging markets, where you have different market leaders in different countries that stand to grow very, very substantially. So yes, our view is that the next 10 years can belong to emerging markets in the same way that the last 10 years belonged to the United States. And a very good way of illustrating that is that many people forget from 2000 to 2010, emerging markets outperformed the United States by roughly 10% annualized. So we have seen this before, and I would argue that we're due a similar rotation once again.
Okay, so in terms of the portfolio positioning, should we increase the exposure to the EM equity by now, or what the Franklin Templeton thinks? Yes.
Well, I think you can guess my answer. My view, of course, and our team's view, more importantly, is that yes, investors should be allocating to EM, both from a structural and a tactical standpoint. And we think it's a whole host of drivers that support this. So yes, we are very much firm believers in managing diversified portfolio, and we think emerging market equities should be a key component of that portfolio. But one does have to, of course, has to recognize there are risks in EM equities and there are risks in all equities. So one, of course, should always be diversified. But I think that's where you guys work with your clients especially well.
Okay, so does it mean that we can invest things in EM markets more than in the US in the portfolio positioning?
I think that's a trickier question for me to answer. I think that comes down to your asset allocation models, I guess within your team, and comes down as well to the risk tolerance of your clients. For the more aggressive investors, you could probably expect a larger relative allocation in EM. But I also should imagine that a lot of your clients already have a home bias, both towards Thailand, of course, and towards Asia. And so what we tend to see here in Asia is that you already have a good level of exposure to Asia. And so it really would depend on of course, the individual client and the circumstances there.
Invest in what you know. Do you try to say it that way?
I'm sorry?
Invest in what you know, right?
Yes, I think people are a lot more confident investing in what they know. Yes, that's right. But sometimes, of course, this is the interesting thing when we speak to our clients based here in Asia and in Thailand. People aren't worried about the supposed risks and of course real risks in Asian equities. Whereas you speak to clients in, for example, the United States, and they look at the asset class very, very differently. They have much more negative perceptions. Whereas I think here on the ground, when you travel and live in Asia, you can see firsthand the resilience of these economies, the strength of the institutions in many markets, and with that, the quality of the companies as well.
Okay, so I guess that's all. And thank you very much for joining our sessions. Okay.
Entirely my pleasure. Thank you very much for having us, and look forward to next time. Thank you very much, Kunal.
Okay, hope to see you again.
Thanks, then.
และนี่ก็เป็นการพูดคุยสำหรับโอกาสการลงทุนในภูมิภาคเอเชียจากคุณอลิสแตร์ แมคโดนัลด์ผู้เชี่ยวชาญจาก Franklin Templeton หากนักลงทุนท่านใดสนใจศึกษาหาความรู้ระดับโลกเพิ่มเติมสามารถศึกษาได้ที่ www.finnomena.com/franklintempleton วันนี้ผมนายสดิษฐ์ กิจสิริสมภพกับทีมงานก็คงต้องขอตัวลาไปก่อนครับไว้เจอกันใหม่โอกาสหน้าสวัสดีครับ